Hi, I'm David Akemi with Berkshire Hathaway Home Services, and today I'm here with Kim Clancy of Mindful Mortgage. How are you today, Kim?
Good. How are you?
Good, good. We're going to continue our wildly popular series on shady tactics. Today we're going to talk about shady lender tactics, stuff we see mortgage companies doing that's just somewhat questionable. And
now, of course, David, none, because we're all straight-laced people. Nothing bad ever happens.
Nothing, never,
No.
Of course. Hey, I wish I could say that, but I see stuff every day, or I hear stuff when I'm talking to clients, and I'm just constantly like, wow, somebody actually told you that? I can't believe people are disseminating or spreading this kind of stuff out there.
Yeah.
But there's so much misperception, so many shady things going on by some of the lenders out there that we need to make a video on it and let people know what's going on.
Agreed.
Yeah, so one of the first things that that I hear a lot from my clients, they'll tell me that I can't have another lender look at my credit because we'll be talking about maybe something that their lender told them, or the interest rate that they were quoted, or the amount of fees they were quoted, and I'm sitting here listening to it thinking, that sounds high, that sounds off. I think some of the people that I work with can probably do better, so I'll suggest that, hey, like any major purchase, mortgage, in that category, you really need to shop it around. Let me have you talk to some of my lenders to make sure that that person's not trying to just knock your head off. And what do they say? They all come back and say, well, I can't. I've been told that my credit score is right on the line, and if I have somebody else pull it, it's going to knock my credit score down to the point where I don't qualify, or now I'm in a higher rate tier. Tell us why that's BS.
So it's just 100% BS, because the way that the credit agencies have set it up is that you can have 14 days. You have a 14-day period to run your credit for mortgages as many times as you like, and it does not negatively affect your credit. Okay. The same also goes for a car loan, just in case you're wondering. So those two things, because they know when you're shopping for a mortgage and or when you're at the dealership shopping for a car, then multiple inquiries are going to happen.
Car dealers are the worst about it, too. I see that all the time. I mean, I've got really good credit. I've got, very high credit score. And even when I walk in there, those guys always try and say, well, your payment's going to be X. And of course, having a mortgage background and being comfortable with numbers, I always kind of crunch the numbers based on what I know my credit union's rate is and what I think I want to spend on the car, I want my approximate loan amount's going to be, so I know where this payment should be. And these guys always come back with their pencil sheet and try and say, oh, your payment's going to be this. I'm like, on what planet? At what rate? And of course, they do that because they're hoping that they'll get somebody that just says, oh, okay. And
they just want to get the car and get out of there.
They just want to get the car and get out of there. And now they sell them a 8 or 9% rate when really that person could have gotten a 3% or 4% rate at their credit union. Same thing happens with mortgage lenders.
Exact same thing. Yeah. So that's why the government put in place this criteria, right? That we can run it more than once and you're okay. So never believe that. Within
a 14-day period, as long as it's from the same category. So several car dealers can pull you within a 14-day period. Several mortgage lenders can pull you within a 14-day period, and it only affects your credit score as one pull. And for what it's worth, the one pull that happens with the first one only knocks like 2 points.
Yeah, 2 to 3 points.
So
very minimal.
It's not like a major hit to your credit to get an inquiry. So, but what I'm seeing is that a lot of these mortgage lenders imply that to the clients, that, oh, you don't want to go get another quote. It's going to damage your credit and you're going to screw this whole process up. And like you said, the whole practice is basically just meant to discourage you from going and getting competing quotes.
Well, they don't even imply it. They blatantly state it that, this will happen, and it's just not true.
Just not true.
Yeah.
Perfect. All right. Well, then that brings us to the next point, application fees. I think that runs along the same lines. They do these big application fees to discourage shopping, because I think they think that maybe once you've paid a big application fee, you got a little more skin in the game with them and you're less likely to go out and shop.
Well, you do, right? I mean, if you were shopping for a mortgage and, lender number one collects $500 from you, you are probably not going to get other people because you're not going to pay $500, assuming that everybody has it.
Assuming that everybody else does it.
And two is, why would you? You would want to just stay with the first person because you're already invested. But you should never, ever pay an upfront application fee.
I agree. Even a fee to get your credit report pulled?
No.
Absolutely not. So you're saying a good, honest, reputable lender eats the cost of that credit report. Yeah. And I have seen lots of lenders that have a credit app fee up front that they try and collect. They want a credit card before they'll even start the process.
No, you never should. Now, it doesn't mean that doesn't happen, but you should not.
Yeah, I know it happens. I hear about it all the time. But you're basically saying that if somebody tries to charge you a credit pull fee or an application fee,
lock-in fee, anything like that, any type of upfront fee, never to go with it.
Stand up and walk. Because there's no guarantee that you're going to get the loan. So a lot of them may be trying to do it as a revenue generator as well. If they think, oh, I know this person's never going to qualify, but at least I want to get the $500 or whatever the amount.
And listen, the credit report is the cost of doing business. Now, you'll find it on your settlement statement at the end when you're closing. Yes, that could be a pass-through fee. Sure. But up front, if I pull somebody's credit, they don't qualify, that's the cost of me doing
So it's
business.
A part of the closing cost, basically. But at that point, you're closing. You're getting a deal. And I think, if I'm not mistaken, they're not allowed to inflate it, right?
No, we have to have an invoice to the title
So
company.
if a credit report costs you $21, they can only pass along $21. So if you've got somebody trying to charge $100 or $500 up front, absolute predatory tactic.
Correct.
Okay, thank you. Thank you for clarifying that. So next one, once again, we're talking about stuff that discourages shopping. And I've seen this a lot of times before. A lender will get somebody with a little bit of a unique income situation, or maybe a little bit of an issue on their credit, or something a little out of the ordinary, and they take that and run with it, and they tell the people, hey, I know I've seen this before. I'm the only one that can get this done. Don't even bother going around. People are other lenders are going to waste your time. Nobody else can do this the way my company does it.
Not true.
Not true.
Now, it could, okay, let me back step. It could be true. They might be the only person that has that specific loan product or is able to do it or doesn't have the overlay. So it could be possibly true, but it doesn't mean the very first person that you talk to and they say you can't do it anywhere else, I would never stick with that.
Yeah, I would agree with that. I mean, especially if you're talking about a Fannie Mae or a Freddie Mae,
for sure.
Freddie Mac, Fannie Mae, FHA loans. So any of the plain vanilla conventional products, any of the government products like FHA or VA, those should have standardized underwriting guidelines that are sent down by Fannie, Freddie, FHA, or VA. Now, you did mention something called overlays.
Yeah.
Overlays might be the one exception to that. Explain just briefly what overlays mean.
So what an overlay is let's say Freddie Mac, for example, says that if you are self-employed and you've been owning your own company for 5 years, we only need to use 1 year of tax returns instead of 2. Okay. That's a Freddie Mac guideline.
Okay.
However, certain lenders will say, yeah, we still want 2 years. And so that's the overlay. It's conditions above
and beyond
what are being called for by the government.
Got it. So they can add stuff on their own. And that would be because they intend to service it and they just want to make sure their portfolio is that much more sound.
I mean, there's lots of reasons. It's riskier. Fannie Mae and Freddie Mac guidelines are actually easier than what most people think. So it's a little bit riskier. The bank doesn't want to take that risk.
Got it. Okay, fair enough. All right, thank you for explaining that. All right, so the next one, and this is a big pet peeve of mine. I hear their commercials, and I'm not going to name any names, but here in the Denver market, all over the radio, you got this big 800-pound gorilla company that's basically claims, we're better, we're cheaper because we use salaried loan officers. Our loan officers are salaried. You're going to get some LO trying to push you into something because they're trying to make a quick commission. I mean, that just irks me to death on a number of levels.
It kills me when I'm like driving down the road and I hear it come on. I'm like, yeah, because it's just not true.
It's BS. Yeah. First of all, I actually have a buddy. I was in the mortgage industry 10 years before I was a realtor. One of the guys that I've known forever, over 20 years, back when I was an LO, I worked at a mortgage brokerage in Denver Tech Center with him. He actually went to work for this company here in town, and we had a long discussion at a dinner party. He's like, oh, yeah, we got a salary, but we're definitely bonused by unit, and we definitely have production goals and quotas even. Yeah. So yeah, they might not be under any kind of incentive to 100% pressure you because they've got a commission coming, but they've got their boss telling them you got to close 20 this month or you're getting fired. Yeah. In fact, that place is a big what's the word? It's a mill,
sweatshop.
Yeah, a sweatshop. I mean, those poor guys. They don't pay them much. No. They don't get paid as much as a regular loan officer. They do get a little bit of a bonus per file, but they're basically under duress of losing their job if they don't get something done.
Agreed. But it's a great starting point but it's just not, you know, it's not the who you want to work with.
Yeah,
right?
and you're never gonna find a superstar loan officer there. The thing that I see about it is anytime, you know, and we see it with brick and mortar banks too, like your big banks. You know, the loan officers that start off there, they get a good training in the industry, but they start to realize after a while, wow, you know, my friend the mortgage broker who does this freelance doesn't have to charge anything more than I do, but he's making like 3 or 4 times more on every one of his loans than I am working at this place on a paycheck that barely covers my rent. So what I see is that when loan officers realize they're good, they get a book of business built up, they get realtors that are loyal to them, and they actually know what they're doing, they leave the salary places. So those salary places become just a giant revolving door where people get their basic training. And once they get any kind of decent level of proficiency, they're out of there.
Well, and the reason that hurts the borrowers is because you have somebody that's not that experienced actually reviewing a file and approving a person. And I can't even name to you over the last 10, 15 years how many times a realtor has called me a week before closing. Oh my God, they're not closing, right? Can you save it? And I'm telling you, most of the time it comes from
that place.
one of 3 places.
One of 3 places. I can tell you, we're not going to name names today, but I know those 3. As a realtor, there are 3 or 4 banks and mortgage companies that when I see a pre-qual letter come across with an offer on one of my listings and I see that name, I'm like, ooh, I like everything about the offer, but we're going to have to call this agent and discuss with them the fact that this pre-qual letter from this lender is going to put their client at a disadvantage. Because as a listing agent, I can't, in good faith, recommend to my seller that they accept that loan because I know we've just seen too many issues with this lender. Like you said, too many times they'll take us 3 weeks into the process, and at the last minute, the loan officer didn't catch something that the underwriter caught, and it should have been something easily catchable by an experienced loan officer. But of course, the kid, we'll call it a kid at this salaried place who doesn't quite know what they're doing yet, caught something, didn't catch something basic, and it blows up in our face at the end. So.
Exactly.
Yeah,
which also leads to a little bit of, you know, the online fast approval people, right? Okay. Is that, you know, there's an advantage to that. But if you are outside the box of approval, you know, being approved, then it's really hard for a computer to tell you that you have an approval when you're self-employed.
Got it.
Right?
Yeah, and when you say the box, we should clarify that. The box just means someone that's got W-2'd income, you're salaried or hourly, and you earn a W-2, and you've got very cut and dry income, as opposed to someone that's self-employed that takes deductions and runs a business and might have a business and a personal return, and things get a lot more complex. Or even commission, even a W-2'd employee that's on commission. What's the rule? If more than 20% of the W-2'd income is derived from commission or bonus, then
it has to be averaged over 2 years.
It's got to be averaged over 2 years, so there are different rules that apply now. And that's another one of the big misperceptions that I see the public has, is that a lot of people say, well, I haven't been on my job for 2 years. And that's not totally true. If you're in business, you've got to be there 2 years. Or if you're, like you said, outside the box with more than 20% of your income coming from salary or commission, then you've got to be there 2 years. But if you've got a W-2 job with a salary, what is it, 30 days?
Yeah. I mean, we're exactly. One pay stub to close. Pay stub. For me.
For you.
So when I talk about specific guidelines, I always refer it to me because it is different for everybody.
Yeah. Okay. That's a good one we need to bring up on. We were talking about a future video that we're going to do where we talk about misperceptions. That's a big misperception, is that you've got to be 2 years on the job. You don't.
No.
30 days on the job if you're W-2'd and salary or hourly. Okay. Perfect. All right. So let's talk a little bit more about misleading online quotes. You were telling me that some of these online lenders, when you go out and do a Google search for mortgage, they're going to put these amazing teaser rates on their ad. And people think, wow, that's way cheaper than what I get quoted locally.
Yes.
But you're telling us that when you get a little deeper into the process, that rate never pans out. Give us some of the reasons why those rates don't pan out.
So number one, it's an advertisement, right? So when you go on and you Google.
A misleading advertisement.
Yeah, but when you go on and you Google, you know, today's rates or how do I get pre-approved or any of the above, whoever you're seeing in front of you that responds has paid for that spot, right? Has paid for your information or has paid for that spot on Google, however it is.
Sure.
Okay. So, of course, they have something to benefit by looking better than they actually are.
Got it.
So what ends up happening is you see, 5 lenders list it at, all these different rates. And, well, that seems a lot lower than I even saw at my bank even. I walked into my bank, it seems lower. Because they are not always on a 30-year fix, so you're not normally comparing apples to apples. There is origination fees that you may not have, but they add on there to bring the rate down because the higher the origination fee, the lower their interest rate can be.
They have to make their money one way or the other in fees or in rate.
Nobody does anything for free.
So we should explain too briefly as a consumer, when you're looking at any mortgage advertisement, they're all required by law to show whatever rate they're claiming they're going to deliver. And then down next to it, they're supposed to show
an APR.
An APR. And what does APR stand for?
Annual percentage rate. But the thing is that if you don't really know, it doesn't matter, right?
Yep. So in a nutshell, an APR basically is the teaser rate that they're offering you, but then how it mathematically washes out by the time you add in the 3 points they're charging you for it, or the 2 points, or 1 point, or whatever the massive underwriting fee is. So let's say the teaser rate that they're putting out there is, you can just use a round number and say it's 5%, but you go down and you see that it's 5% with an APR of 6.49. That tells you they're probably charging you a ton of money to get that 5% rate. And when you're talking about, let's just say a $500,000 typical starter home, every point is 1% of 500,000 would be $5,000. So if somebody's charging you 3 points, it means there's $15,000 in junk fees to buy that rate down. And that's still in addition to the tax escrows, the insurance escrows, the title fees, the appraisal, the credit report, all the other little fees that are in line. So if they're putting 3 points on, then you probably have another 1.5 or 2 points of legitimate
fees. And it's just an advertisement, right? Think about it like that. I get in the mail all the time the advertisements, like, oh, here's refinance into this rate. They're advertisements, and so they're not going to advertise what it really is. They're going to tease you
to
so
get you in the door.
Yeah.
So buyer beware. Just be careful if you see some ridiculously low rate advertised out there, because you really want to look at the big picture. How much are the fees? Is it even a 30-year fixed product? Is it, or it could be a 15-year fix, which have lower rates. They do come lower, but the payment is a lot more money. Or even a 20-year. It could be somewhere in between, because both of those carry a little bit lower interest rate than a 30. Correct. But for a typical consumer, you can't really afford a 15 or a 20 year. So could be something like that.
Yep.
And that comes down to what we just covered, overcharging for rates and fees.
Yeah.
That's the other big one. Even when you've got a lender that's a legitimate lender that's not necessarily what I would consider shady, different lenders at different mortgage companies have more overhead than others. I mean, that's one of the reasons we really love working with you. You're a mortgage broker. You're super experienced. You've been doing this 20 years, so you know what you're doing. I'd put you up against anybody from a knowledge standpoint. But the beauty of it is you work with how many wholesale banks have you?
I have 14.
14. So you receive the daily rates, and actually they come in more than daily. Sometimes on a volatile market day, they can fluctuate multiple times a day. But you receive the current rates from 14 banks. So you can take someone's application and at a glance say, okay, today out of the 14, this one has the lowest rates.
Correct.
Which is awesome. I mean, a lot of these companies, these mortgage companies, and we won't name names, and especially brick and mortar banks, if you walk into your bank, you're getting that bank's rate for the day. And, there are how many hundreds of banks are there out there? You probably have isolated over time the top 14 or 15 that consistently have the cheapest rates. And then out of those 14 cheapest, you can look at it on an up-to-the-minute basis and say, this one is actually the cheapest by far right now.
Yeah.
And that's who you send their file to. So that's the beauty of working with a broker.
Yeah.
You don't, you're not stuck or beholden to one company's rates.
And nobody determines it except for me, right? So we call them raw rates. We have raw rates. If I worked at, let's say, a retail lender, then the people that are in charge of the pricing are the ones who dictate what the rates are for all of their loan officers, right? Okay. So the loan officer logs in, they have one thing that they see, that's the rate, that's what it is, right? Now, sometimes they can go to their manager and ask for some exceptions or whatever, but that's basically it. For me, I have raw rates. So I put it into a pricing engine. All 14 of my lenders come back, and then I say, okay, now some days somebody is really low, but we have to do a short close, and I know that lender is not going to be fast, right? So, you take a lot into consideration. But definitely I am at a real big advantage in the broker world.
Well, and I think you said the magic word, too. When you talked about the other company and that loan officer that's presented with one set of rates, you said he can go talk to his manager to see if they can do anything.
Yes.
That's the one thing that I've noticed. When I spent my time in the mortgage industry, I worked for some big companies that had that model where they said, here you go, loan officers, here's the rate you have to sell today. And I can tell you those companies always had a manager. They always had a district manager. They had a regional manager. They had a team of processors. They had a team of closers. They had a team of QC people. I mean, you name it. They had a big brick and mortar granite building somewhere with thousands of dollars, in monthly. So basically, the more layers of bureaucracy and management and middle management and upper management you put into a mortgage company, those guys all have to get paid somewhere, and they usually make big salaries and big bonuses.
Huge.
So that's
where does it come from? It comes from the borrower.
Comes from the rates and the cost that they've got to charge the borrower. Where, like you said, it's you, it's just you and the wholesale bank's rate. So you got no extra layers of padding. I mean, you do drive a nice car, though.
Oh,
but you earned it.
I can keep one of them.
If you can keep one of them. But you've paid your dues, and I'd say overall, when I send you people, very, very rarely does anybody present you with any kind of an outside quote that you can't, at the very least, match, and you usually beat it, and your costs are lower. And the big thing that I always know when I send it to somebody that I've worked with for a while that's got your level of experience is that it's going to close on time.
Yeah.
You're never going to tell me, yes, I can close this in 28 days, and at the 26th day say, oh, we made a mistake, we missed something. I just never get that. So that, I can't tell you how important that is, especially in this market with rates increasing, because if a lender messes something up and doesn't catch it at the last minute, what happens if the rates this week are 3/4 of a point higher than they were 3 weeks ago when you started? If that lender screwed up and they locked but made a mistake and now they can't close it, and now you got to switch, but the market's way higher, you can end up in a point where you no longer qualify for the amount of house you were trying to pay for.
Agreed.
It can go wrong in so many ways.
Yes.
Well, hey, I massively appreciate you showing up today and helping talk to our audience and answer some of these questions.
Always
a pleasure to have you on. Thank you so much. If you like what you see today, hit that like and subscribe button. We put content like this out all the time. If you have a specific question on something that you'd like to see us film content on in the future, let us know here in the comments and we'll get something made for you. Thanks again.
Thank you.
Bye-bye.